Tag TV, and Tag Radio. Technology now has a voice of innovation and information. Get it on www.tagtvonline.com. The global financial crisis of 2008, in the view of some experts, the worst of its kind since the Great Depression. It became predominantly visible last September with the failure, merger, or conservatorship of several large United States banks. The underlying cause reported in business journals was the subprime mortgage crisis. It rapidly evolved into a global financial crisis, resulting in a number of European bank failures, declines in various stock indexes, and significant reductions in the market value of equities and commodities worldwide. Greetings, everyone. It's Tuesday, November 4th, 2008, Presidential Election Day, as voters across the United States go to the polls to not only select a new president, but a new perspective and resulting government strategy on the future economy of the United States. This is a special Election Day Tech Talk with Technology Association of Georgia President Tino Mantella. Today, Tino begins a series of in-depth looks at the economics and financial forecasting of the United States economy with this week's guest, Dr. Thomas Danny Boston, professor of economics at Georgia Tech. A successful entrepreneur, Dr. Boston was the former president of Boston Research Group. And recently, he launched a new enterprise, UQuant, positioned to rapidly become a leading provider of quantitative research and information on domestic, emerging markets, and underserved communities. Dr. Danny holds a Ph.D. in economics from Cornell University, a former president of the National Economic Association, editor of the Review of Black Political Economy, and senior economist to the Joint Economic Committee of Congress. A past advisor to the U.S. Small Business Administration, U.S. Department of Commerce, and Congressional Black Caucus Foundations. He currently serves as an advisor to the Georgia Department of Transportation, the Nigerian National Assembly, and has worked with UNESCO Brazil. Author of 6 books, he is the past recipient of Georgia Tech's Ivan Allen College Legacy Award, Tech's Faculty of the Year Award, and the state's Economic Educator of the Year. Tech Talk turns to the future direction of the economy and the trends that business should be aware of in the future as Tino speaks with distinguished expert, global advisor, speaker, and author, Georgia Tech Professor of Economics, Dr. Thomas Danny Boston.
Dr. Boston, thank you for joining me on Tech Talk today.
My pleasure. It's a pleasure to be here.
Well, I wish we were having this conversation in a more vibrant economic time, but it is what it is, and this month we're talking to folks that are as expert as I guess you can be in this economy to tell us their views on the economy. And I think a good place to start, being that this is our first one of the series, would be to build a foundation. And so the first question I have for you is, what are some of the important indicators that signal the direction of the economy?
Well, yeah, a very good question. It's important also to understand historically where we've been, because there are a great deal of similarities between where we are today in terms of the economic environment and the kind of events that occurred during the Great Depression. There are a lot of similarities, and so if we look at those similarities and trends, it will allow us to really understand the present and forecast the future a lot better. Some of the things we want to really be mindful of are, first of all, and in fact we've kind of lost sight of this, and that is the fundamentals of the economy. There are 2 sectors in the economy primarily that we look at, although there are more, but let me just talk about 2. One is the financial sector, where we have all of the money markets and assets, right, and others. And then you have the goods and services sector, where we actually do a lot of where the production and output takes place. The problem today is that while we're stabilizing the monetary sector, that other sector, the goods and services sector, is continuing to decline. And so we need to really focus on that sector much more urgently and look at the kinds of factors that are necessary in order to stimulate the economy to grow. What's giving us some indication about where we're headed, for example, if we look at unemployment claims, and we see that those unemployment claims are going way up, and so that we would expect that next Friday, in fact, this coming Friday, when the first unemployment figures are announced for the month, that those figures will go up. So that's one of the leading indicators. Another, for example, is housing starts is a leading indicator. There are a number of leading indicators in that we look at that will give us some understanding of what the future is likely to look like in regards to where we are economically.
Well, you'd mentioned jobs, and of course we've all been reading about the job cuts, and particularly, to my surprise, Georgia has been compared to Michigan in terms of being right up there at the top. Do you have any sense as to why that would be?
Yeah, well, Michigan is a different animal,
of course,
in the sense
right.
that you got the auto industry, but what makes Georgia particularly problematic is the fact that you had so many subprime mortgages extended in the state, particularly in the metro area, and in states where you've had during the bubble a robust run up in the real estate market. For example, California and Florida. Those are the states that are getting really decimated. And Georgia was there for two reasons. One, not only because we had so many loans that were subprime mortgage categories, and those loans are going into default, but also because it's a state that is driven to a large extent by real estate investment. And so that with the meltdown in the financial sector and the growing defaults in home ownership, then that's hitting banks in the state very hard. And as those banks get hit hard, they can't extend loans, and therefore it's sort of a ripple effect in terms of growing unemployment.
Well, thanks for that answer, because I think it's, as I said, I think people were quite surprised that we were towards the worst in respect to some of the job loss. And, it must be really difficult right now for any economist to forecast what's going to happen. So that's my next question for you. But I would add to that this idea about with the, we're reading in the paper about job losses with the big companies, and and as you see that, I mean, it seems like there's a spiral that it would have to, because you had mentioned goods and services, and it would seem like that one's going to lead to the other. With more unemployment, there's going to be less purchase of goods and services, and therefore more layoffs. So how do you reverse that cycle? I guess I asked you two questions there, Dr. Buss.
Yeah, no problem. Yeah, and you've really hit the nail on the head. One of the things that I've been advocating is that we have to give more attention to that goods and services sector. And here's the problem: we are in the midst of what's called in economic terminology a liquidity trap. Now, what that means is simply this: if you think of a giant funnel, and you're pouring all of your money into this funnel, and you hope that at the other end of the funnel, something is going to come out in the form of loans and money available for new investment in technology and manufacturing and other things. Well, we're pouring all the money into the funnel, but nothing is coming out of the other end. And it's not coming out of the other end. This is the same thing that happened during the Great Depression. The reason that it's not coming out of the other end is because financial institutions that are getting this money are simply sitting on it. They're either paying down their debt, and they're sitting on it, and they're hesitant to loan the money because they feel pessimistic about the ability of individuals, whether that's homeowners or small businesses or large businesses, to repay. And so their first instinct is to say, look, let's just sit tight and see what the future is going to look like, as opposed to going extending loans and then getting ourselves into financial trouble. So the government has been pouring, particularly the Treasury and the Fed, have been pouring money into the financial sector. I mean, keep in mind, for example, we spent hundreds of billions of dollars bailing out Bear Stearns and Fannie Mae, Freddie Mac. Then you got another $700 billion financial rescue package, and now we got a $250 billion, package where we're buying equity, and none of which is happening. Nothing is happening. We got to focus on goods and services to stimulate that sector to grow, and that was the lesson of the Great Depression. So if we talk about what can happen in the future, the extent to which we can stimulate that sector to grow is the extent to which we will come out of where we are now sooner rather than later. But if we continue to focus only on the financial sector, my fear is that we're going to be stuck here for a while. So in terms of some of the things that we want to look for, again, we want to look for any pickup in investor optimism. Are they both investor and consumer optimism? Are they becoming more optimistic? If their monthly surveys of both consumers and investors, and one of the real gauges is what is their outlook? Is that outlook now stabilizing, or is it continuing to decline, or is it increasing? And as investors and consumers get more optimistic, of course, consumers will spend more and investors will invest more, and that's going to really be the key to when the economy is going to turn around. So we want to look for that in terms of what's going to happen in the future.
Of course, it's interesting watching the market with 900-point swings one way or the other. So I guess when you're talking about looking at the market as one of the indicators, we probably have to get some kind of a trend going, I would guess.
Yeah, exactly. And you really can't base that on the market. The market is just trying to anticipate the future. And it's going to swing wildly as it gets different signals. It may swing today if we get earnings reports. There may be, for example, one particular company that has a good earnings report, and the market will swing up wildly. And we may get large unemployment claims, and it'll tank. So you can't really judge it by the market. The market is a signal. The underlying trend you can make some inferences on, but again, to the listener, they would be well advised not to pay a lot of attention to the wild swings in the market on a daily basis, but kind of look at the underlying trend. And that underlying trend is going to be tied ultimately to the earnings and productive capability of the economy. So if the value of goods and services and incomes will increase as, for example, we're able to gradually increase our productivity and output, and as that happens, then the values of companies and their earnings capabilities will increase, and that market trend will go up. But we certainly, again, in today's market, can't make judgments based on these wild swings.
You had, we all know that the $700 billion and growing investment in the financial areas was the strategy that the government used to try to move us in the right direction here. And I'm just wondering your thoughts about, you had referenced the Great Depression, and I'm not a student of the Great Depression necessarily, but I think most of us know that under President Roosevelt there was a major investment in jobs and industry and construction, and
Sure.
Just wondered your thoughts about, why wouldn't that be the approach to sort of try to fuel the economy with more, and I know there's discussion around this now, but with more direct industry sort of applications where it could create jobs, and then people can pay their mortgages and do the things they need to do.
Absolutely, and that's exactly what needs to happen. There's in a sense really the whole emphasis on the financial crisis has become skewed. In other words, it was important that the Federal Reserve and the Treasury stabilized the rapid decline or the rapid meltdown in the financial sector. But what they've done is they've just constantly committed all of our resources to that sector and neglected this goods and services sector, which is not a good thing, because the bad part about it is, as I mentioned, on the one hand, despite all of the money that we've committed to the sector, we're getting very little in the form of loans, that's coming out of it
Right.
as a result. And now Congress is upset, saying, what's going on? We put all this money there, and they're not lending anything. So that's a problem. And they're not going to lend anything unless they are optimistic about being able to make a return on those loans. So we got to get this goods and services sector moving. Now, the same thing happened as you mentioned, during the Great Depression. The Great Depression was brought on by just a stock market bubble that was all out of proportion to the fundamental production of goods and services, and the economy all of a sudden collapsed. And when the stock market collapsed, people's wealth just diminished, and as wealth diminished, investment stopped. The businesses stopped investing and consumers stopped spending. Well, the government finally, after a while, came to recognize that as banks were going into default, they needed to stop those from defaulting, but they continued to pump money into the economy to stabilize the banking system. Eventually, the interest rate went down below 1%, and nothing happened. No new investment was taking place, and we just sat there in the depths of the Depression for several years until Roosevelt came along and said, look, we need to stimulate the goods and services sector, and that's where we got these massive, the New Deal, the WPA,
right,
and other kinds of programs that actually put people to work and put incomes in people's hands, and revenue coming to businesses that got us moving again. And so that's what we need to do today. We really need to focus on that sector if we're going to move beyond this current crisis that we're in.
So a lot of our listeners are in the technology space. They're working in companies that produce technology, or they're working in companies that are tech-enabled, and there's major support for technology through the IT departments. And I'm sure they're, like many of us, concerned and a little bit confused about getting good information. Mm-hmm. Where would you advise that individuals and companies go to get information for the best economic forecast?
Well, if the information for the best forecast comes from the blue chip, there's a blue chip indicator, and it's called the Blue Chip 50, and you could actually go and Google this. Just Google, put in Blue Chip 50, and it'll come up. And what that is that the company, Blue Chip, which is a nonprofit organization, collects the 50 top forecasts in the country. They go to the organizations that are the leading forecasting organizations, and they collect their forecasts, and then they publish their forecasts. And what they do is they will publish a median value, meaning half above or half below. And that median value, they'll look at things like, for example, what is the interest rate likely to be over the next year? What's the level of unemployment? What's the inflation rate? What's the level of output? All of those things, so that if you're interested in those issues, for example, a company may be interested in making an investment and wants to know, should I make it now or should I wait? Will interest rates go up or go down? So that Blue Chip will give you that, and it also publishes what's called the Blue Chip Plus 10 and the Blue Chip Minus 10. So the Plus 10 will give you, of those 50 forecasts, it'll give you those 10 organizations that are the highest in terms of their forecasts. That'll give you the average of the highest 10 and also give you the average of the lowest 10. So then what you have is a band. You got a medium forecast, and then you got a high end and a low end. And so that will give individual corporations and businesses sort of a good blueprint that they can judge their future business and investment plans around.
Well, that should be really helpful to our listeners. So the Blue Chip 50, you can Google that and go to the site, and it will be one of your better economic forecasting tools. So let's end where we started. I'm running out of time, but if for business owners, if they're going to pick a few trends that they need to follow, what would they be?
Well, particularly in the technology sector, of course, I probably don't need to tell the listeners this, but of course you have to see where your industry is heading. And for so long we were the world's leaders in technology, and we still are the world's leaders in technology. And to the extent to which we get back to those economic fundamentals will be the extent to which we can again assume our economic leadership in the world. But of course you have to keep abreast of the trends that are taking place within your industry. It's important also to keep abreast of this Blue Chip 50 that I mentioned. It's good to have an understanding of where the economy is likely to go. Is it likely to slow down, or is it going to stabilize, or will people begin hiring, or what have you, so that you can better position your company relative to the likely changes in the market. So those things are important. And it's also important that you look at, for example, the level of consumer and investor optimism. That's very important. In fact, the most important factor in determining the sort of indicator in terms of where we're going to be in the future is the level of optimism. And that's got a real intangible, but it's kind of like, how do you and I feel about the future?
Right.
And if we feel good about the future, we're going to invest and we're going to spend. If we feel pessimistic, we're going to cut back. So those things that one should always keep their eye on in regards to better positioning their business for the future.
Well, Dr. Boston, thank you for joining me on Tech Talk. I think this will be very insightful information for our listeners, and let's all hope that we do create some optimism and move forward. So thank you for joining me.
And thank you for having me.